These are the top 3 companies that I'm looking for an opportunity to add even more to my portfolio going into 2025. I think by now you would have seen many videos on YouTube titled, the top X number of stocks to add or to buy in 2025. And so the question is, what makes this video different and why should you actually be watching this video to the end? Simply put, it's because nobody actually knows the future, and I'm telling you that up front. You see, when you watch all these videos of people telling you the top X number of stocks to buy in 2025, the fact of the matter is nobody actually knows for sure whether these companies will actually outperform the market. And what I'm about to do in this video is not just to give you the fish, but to teach you how to fish. What this means is that in this video, I'm not just going to be plainly talking about the companies to invest in 2025 and some of the background about these companies. I'm going to be talking about actual metrics for each of these individual companies that you can actually use to gauge the performance of the business of these companies to actually understand whether or not they're performing well as we go through 2025. And hopefully with a strong macro environment, that will also mean that the stock price will follow the business performance of the company. Now, in addition to all of this, what I'll be doing is I'll be talking about the risks that are facing some of these companies. What is it exactly we need to look out for and how to assess the risk to gauge whether or not the long-term thesis for these companies are still intact and whether or not there is still potential for growth. But as always, potential is a dangerous word, so let's dive in. First things first, I think if you have been following my channel for quite some time, I think it shouldn't surprise you that going into 2025, that my favorite investment for the year is actually SOFI. However, because I've been talking about SOFI so much over the last couple of weeks, I'm going to completely exclude it from the list and only talk about companies that I'm either looking to start a position in or expand its current sizing within my portfolio. Now, when it comes to the companies that are ranked 1 and 2 on this list, it was actually quite a close call and it was quite a hard decision to make. And I think the main reason behind that is that because I had minor concerns regarding both of these companies. And actually, in this video, I actually only cover a list of around 3 companies. But the truth is I actually have a short list of 8 to 10 companies that I'm looking at going into 2025. Now, because of that, when I was choosing the third company, it also came to a 3-way tie. And so I've decided to basically include 2 special mentions when I talk about my third company as well. Now, I think after the most recent FOMC meeting, the Federal Reserve have left investors slightly frustrated, perhaps a little bit confused at their policy-making decision because they do seem to be flip-flopping from what they have said regarding policy previously. Now, personally, to me as an investor, I do think it's important to keep an eye on the developments in the macroeconomy, not because I think it will, change the long-term thesis of the companies that we invest in, but what it does is that because some of these companies, how well they actually perform is dependent of the macro environment that we find ourselves in. And so what this does and understanding the developments in the macro environment will help us inform our expectations for these companies going forward. But let's start with the third place company. And honestly, for me, this was a 3-way tie between ASML, Grab Holdings, and Enphase. Now, all things considered, the first of the 3 companies I decided to actually strike off the list is ASML. Now, don't get me wrong, I think personally, I do think that ASML is a fantastic company. They have a very strong moat. They're definitely the leader in their space. Now, being the only company in the world that produces EUV lithography equipment, I think this equipment, we have to understand that it's not easy to make. It takes a lot of research, and each of this machine actually consists of over 100,000 components. So, to say that someone else can easily enter into this space and take market share away from them, it actually requires a lot of capital, it requires a lot of research, and that itself is a moat for any potential competitor. So, my issue with this company and why it's the first one to actually be struck off the list is due to the timeline of this video being 2025. Now, you see, ASML has recently guided for a slowdown in sales in 2025 due to weaknesses they notice in certain segments of the semiconductor market. Now, of course, if you have a long enough time horizon, right, this might make a good entry point for you because you do have the time horizon in order to, tide through the cyclicality of the semiconductor industry. But at least for me, I prefer to take a more wait and see approach because I think I don't know for sure whether or not this reduction in guidance in 2025 will affect their long-term targets. You see, ASML is actually one of these companies that give investors a very long kind of projections. They currently guide for 2025 all the way up to 2030. Now, currently, as of now, basically they have reduced their 2025 guidance, but they have actually kept their 2030 guidance intact. But whether or not it stays intact really remains to be seen. And for me, I want to actually see the extent of the slowdown in 2025 to understand whether or not their guidance in 2030 will be affected. So to me, they do have a strong moat. They are still the leader in the industry, and they will continue to benefit from the growing demands in the AI sector. But because of slowdown in other areas of the semiconductor industry, that may actually cause it to hinder its growth in 2025. And so because of that, they are the first company to be struck off the list. And then when it comes down to Grab and Enphase, this was a much tougher decision. I think when I consider these two companies, I consider them as the market leader in their industry. Enphase is the leader in the microinverter space, and Grab in the ride-hailing and food delivery space, at least in Southeast Asia. Now, in Enphase case, they are actually coming out of a bad year. I think in my previous video over here, where I go into more detail of the company, I actually show how the revenue trend has started to inflect upwards, and what we need to look out for going into 2025 is to actually see whether or not this inflection upwards is reflective of a longer term trend, a longer term reversal in terms of where revenues will go for this company. Now, at the same time, I also do think that, coming out from bad year, what this means is that when they report their 2025 numbers, they will have easier comps. So I expect them to re-accelerate growth as well. So all in all, I do think that the company has been executing. So for me in particular, what I want to keep track of for this company is inventory levels. And if you want to know how I keep track of inventory levels, you can actually go back and click on the video that I linked up above previously. And another thing I want to keep track of for this company is actually the number of installers they have on their Enphase network. Now, apart from this, I think we do have to pay attention to policy decisions. I think one of the reasons why Enphase has sold off is due to the high rate environment, and that makes installing a solar system less attractive. And I think, the fact that Donald Trump appears to be not as pro-green energy, that has actually contributed to some of the fear around this company. Now, despite the Federal Reserve actually lowering rates, I think the 10-year yield has increased by around 100 basis points since then. So, there are fears of a second wave of inflation because of the policies and the tariffs that Trump wants to bring into office. But at the same time, I think we also know that Trump prefers a slightly weaker dollar. Now, that will actually bring in more foreign investors into the US, and hopefully that will continue to drive yields down. And when that happens, I think we are hopeful, or I am hopeful, to actually see demand for Enphase go up. Now, another concern people have is that, Trump may repeal the IRA, but personally, I think even if the consumer tax credits are taken away, as long as the manufacturing credits still remain, and I do believe it is in Trump's best interest to keep these credits intact, then Enphase will not be as severely affected, because these manufacturing credits reduce production costs that actually boost their profitability, and that actually allows them to remain competitive in terms of their pricing. Now, on top of all of this, I think we have seen previously that there is strong demand for Enphase products, and so if rates continue to come down, I think even if the tax credits are removed, it's safe to assume that, demand for Enphase will continue to come back. Now, additionally, we also have to remember that Enphase has a very global customer base, and as Europe continues to recover, so will some of the demand in the area, because it's actually Europe that actually pulled down some of their revenue in their most recent quarter. Now, when it comes to Grab, I'm definitely bullish on the company, and I'm also bullish on the region that they are serving. I think it has a phenomenal growth opportunity in front of it in the Southeast Asian market. It is definitely the dominant player in the ride-hailing and food delivery space, and I think that its venture into the financial services sector is the right move, as it aims to capture new market and enter into new verticals. However, as I was mentioning in my previous video, which I will link over here when I talked about Grab in a little bit more detail, when people talk about the opportunity that is in front of Grab, we have to realize that this is an entire region with 11 different governments and 11 different countries at different stages of growth. Now, currently, the issue that I have is that a large majority of the GDP produced within Southeast Asia is concentrated to just a few countries. And personally, I think, to me, while they have taken on a good strategy to expand their financial services business starting from Singapore and Malaysia, I do have my concerns over here. And so when it comes to understanding Grab's financial services segment, I think it's important for us to, understand some of these numbers over here. In 2022, there were around 88,000 platform workers on Grab. So platform workers basically refer to Grab drivers and delivery workers and things like that. A total of around 143,000 sole proprietorships in Singapore. Now, why this is important is because, when you talk about Grab and their financial services segment, they actually plan to target this particular group of workers, people who are platform workers, people who are in the gig economy and things like that. And this actually makes up a very, very small proportion of the Singapore workforce. And so despite the high GDP within Singapore, I think the market here is definitely limited. limited, and the financial landscape in Singapore is pretty competitive. So to me, actually, the Malaysia side of the financial services expansion might be more important for them, because I believe that actually gives them the data they need to underwrite loans of a similar quality for other countries within Southeast Asia, especially countries like Thailand and Vietnam. And I believe this is where the real opportunity for them lies. However, to think that they will actually see growth in this area in 2025 might be a little bit too soon. I think they need a couple more years to see a real scaling and growth in this area. Now, personally, I've eventually decided to put Enphase in third place over Grab, because while I believe, some of the concerns that people have over Trump and his policies regarding green energy, I think all these concerns are valid. I think from an outsider's perspective, I think for me, not everything he does will actually be bad for Enphase. You see, if he actually keeps the manufacturing credits, if he reduces corporate tax rates and things like that, and manages to bring in more foreign investment into the US, I think eventually Enphase will benefit. And I think I've mentioned this in my previous video as well, that during the last Trump presidency, Enphase was actually growing at a very fast pace as well. So that's why I don't think there's any correlation, or not much correlation, between Trump's presidency and the slowdown or the fears of a slowdown in Enphase. Now, when it comes to Grab, yes, I have my concerns about how fast they can actually scale their financial services business in Singapore, but I do think it's undeniable that they have a huge opportunity for growth in front of them within the Southeast Asian region in the financial services sector. Now, you see, that is actually not the reason why Grab didn't make it into third place. For me, the real reason why I did not put Grab in third place is actually the large numbers of their shares outstanding. Grab is actually a company that just turned profitable, and the large number of shares outstanding means a slower growth in earnings per share. And that is because the earnings per share of a company is calculated by taking their net income, dividing it by the total number of shares outstanding. And so this total number of shares outstanding is the denominator in the equation, and the bigger this number is, the higher the numerator needs to be, which is the net income, the higher that needs to be in order to drive up growth in EPS. And EPS is important because that is what we use to apply the PE ratio to. So currently for Grab, because they have just turned profitable, I really want to see how fast they can grow their net income and how fast they can actually scale their earnings per share. Now currently, Grab has around 4 billion shares outstanding, and so that means in order for them to generate 10 cents in EPS, they would need around 400 million in net profit, and net profit in the last quarter actually came in at 15 million. And so to me, this investment would actually make more sense with a 2026 or 2027 kind of timeline in terms of the expectation. And now we have come to the second company, and to me, when I look at the decline of the stock price of this second company, it kind of reminds me of buying, Tesla below $195 or buying Google in the 120s. Of course, there are some slight differences over here. Now, in fact, I'm talking about Advanced Micro Devices, or AMD, and I want to start off by acknowledging some of the slight differences in this scenario compared to buying Tesla and Google. Now, back in the day when I was buying Tesla and Google at those prices, I bought them knowing that these companies were the number one company in the space that they're operating in. However, in AMD's case, I know for sure that they are not the number one right now. However, I do believe that they are a solid number two in the AI chips and data center space. Now, AMD to me is a company that is victim to the poor sentiment around its company due to some softness within the chip sector, and I think a large part of that is also down to who they're being compared with, right? So your growth compared to Nvidia's growth will always seem anemic. And I think there's no doubt that, to me, at least in my mind, that Nvidia's product is the best in class, and that is actually proven by the fact that they have the dominant market share over here. Now, however, the thing is, when you invest in companies that are going after a big total addressable market, everybody can win at the same time. Now, for me, going into this investment, I'm not going in expecting AMD to one day overtake Nvidia or anything like that. I'm going in with the very clear idea that I'm buying the number two company, a very competent number two company in a fast-growing industry. Now, the AI chips and data center space is expected to reach a $500 billion market size by 2028. Now, currently, depending on which report you read, AMD holds somewhere between a 10 to 11% market share in this area. And in actual revenue terms, if we take a look at their most recent quarter, they brought in around $3.5 billion in revenue from their data center. And if you take a look at the first 2 quarters of 2024, they actually brought in $2.3 and $2.4 billion in data center revenue respectively. Now, if you take a look at the fourth quarter of this year, they actually projected a 10% sequential exponential growth across their entire revenue. So I think if you actually, extend that assumption just to the data center revenue itself, we can expect data center revenue to come in anywhere between $3.8 to $4 billion. And so that would make their total data center revenue for the whole year of 2024 come in at around $12.1 billion. Now, why is it important for us as investors to understand this revenue number? Is because over the next couple of years, if AMD doesn't manage to grow their market share in this area, as long as they manage to retain their 10 to 11% share of the market, as the AI chips and data center market continues to grow, as it reaches that $500 billion market in 2028 or even perhaps in 2029, their $12 billion in revenue will eventually grow to around $55 billion across the next 4 years. Now, that is slightly more than a 4x in revenue, and that is actually just one portion of their business, because on top of this, you also have to consider their server CPU business, where they are continuing to take market share away from companies like Intel, who are still looking for another CEO. Now, moving forward, I do think that the AI workload is slowly shifting to inference. Now, this term was actually new to me when I first started looking into AMD, but this term actually came out a couple of times in some of the earnings call. So basically, in very simple terms, I think previously the focus in the AI space was to build out and train some of these AI models, and that is where, NVIDIA has been dominant. And so what AI inference is basically after the AI model is being trained, right? When the user makes use of the AI model, it's required to, interpret the data based on the user's input and give a response. And this is where AMD is actually positioning themselves and their chips to be able to do the interpretation of data. And that is where the bulk of AMD's AI revenue currently is coming from in this segment of the market. And so in the third quarter earnings call, Lisa Su actually referenced how companies like Meta and Microsoft has actually previously made use of their chips for AI inference workload, but are actually also expanding the use cases of AMD's chips to include training workloads as well, which is good for them, because the training and the building of all these AI models is the segment that NVIDIA holds the dominant market share, and this is AMD's strategy to kind of penetrate into that space. Now, going into 2025, I think we expect AMD to grow their earnings per share by over 50% before eventually moderating to a low 30s or even high 20% growth rate for the rest of the decade. Now, this has largely to do with their growth in the AI chips and data center space, both of which are actually high margin products, as well as the integration of Xilinx. I think Xilinx is the company that they purchased back in 2022. And so on top of that, in the third quarter of this year, they actually generated $619 million in free cash flow, and when it comes to their balance sheet, they have over $4.5 billion in cash, so their balance sheet is very healthy. And so ultimately, for me, I think for AMD, why it's not at the number one spot, but I've chosen to put it at the number two spot, is because they're not a leader in the industry that they're mainly operating in. And I think in the long term, it doesn't seem like, at least from my last couple of weeks of research, it doesn't seem like they have any plans to disrupt or overtake NVIDIA anytime soon. I think the strategy that they are taking is more of one of trying to play within the spaces in the AI industry that NVIDIA isn't currently focused on, and they're happy with just, taking a part of the pie. And you know what? I think to me, that doesn't actually make it a bad investment, but I think it's for my investing style. It's not the kind of company that I would want to take up a sizable position in the long term. If I want to make this a sizable portion of my portfolio, this has to be a market leader. And so if you look at this little exchange during the earnings call, I think when one of the analysts asked about how they plan to close the gap with NVIDIA and whether or not they see the release of their MI350 series being able to close the gap, I think Lisa Su actually concedes that, even with the release of the 350 series, that will not really close the gap. But she does argue that from where they have started, which is way behind NVIDIA's H100, the gap has been closed significantly since then, and currently the products that they have are competitive with the H200s. And at the same time, the MI350 series that will be released in the second half of 2025 will be competitive with NVIDIA's Blackwell chips. However, they do seem to be half a cycle behind, because I think by the time they release their MI350 series, NVIDIA is basically poised to release their second version of their Blackwell chips at that point in time. And I guess currently, because of the constraints in terms of supply of AI chips, there is still plenty of demand for AMD's chips. And I guess, for many of these companies who are actually using NVIDIA's chips, they do not want to be overly reliant on just one vendor for all these chips as well. And so what AMD does, it provides a lot of these companies a very competent second choice for AI chips. So I think going into next year, we do have to pay attention to margin expansion from AMD and also to continue to keep track of their market share within the AI chips and data center segment. And I think one of the things that is also important for us to keep track of is their strength in terms of their market positioning when it comes to the AI inference workload over here. Because I think within the company itself, there seems to be an emphasis in growing within this segment of the AI industry. And so if that is what the company wants to do, that is something we have to keep track of. And so personally, for me, what makes AMD an attractive proposition going into 2025, despite some of the concerns I've mentioned earlier about them not being a market leader, is basically how far the stock has fallen. Now, currently, if you look at the price to sales ratio, they may seem a little bit pricey at this range. I think they're trading at around 8 times price to sales. But if you look at their PEG ratio, they're currently trading at a 0.32 PEG and a 2025 forward PE ratio of around 25. And ultimately, the semiconductor sector is actually quite a cyclical industry, and so we do need to pay attention to any shifts in demand going forward. And so we have come to the final company in this video, which is also the company that I've decided to put at the number 1 spot behind SOFI. Now, in all honesty, I was actually really debating whether or not this company deserves the number 1 spot, because to me, valuation is definitely a concern, but not in the way that you might think. I'm actually talking about Hims and Hers. Now, with Hims and Hers, we are potentially investing in the number 1 player within a very niche industry, but valuations are slightly rich depending, if you consider some of the risk factors that are involved with this investment. Now, I really like the opportunity that is in front of this company, and if management continues to execute well, I have no doubt that the company will do well and the stock price will eventually follow. You see, currently it's trading at a 46 times forward PE and a 5 times price to sales. And of course, all is well and good if we find ourselves in a bull market in 2025. However, if market sentiment changes, there could really be a big correction in this company over here. Because Hims and Hers is really a company that is driven by narratives. And if you tell me that at the end of 2025, this company is back at $12, I wouldn't be surprised. But at the same time, if you tell me that this company is above $40, I wouldn't be surprised either. And so if you're not one that can really stomach the volatility, perhaps this investment is not for you. I think for me, the more I look into this company, the more I like what they're trying to do. I really resonate with their mission and vision. And over time, I've started to realize that, their total addressable market is really ever expanding, because what they're doing is that they're giving their customers a personalized way to receive treatments for various medical conditions. And the extent of their market share is the extent to which they're able to penetrate different verticals of different medical conditions. Now, in the third quarter of 2024, revenue came in at $401 million, which represented a 77% year-over-year growth. Their net income basically also came in at $75.6 million, and their free cash flow came in at $79.4 million, which represented a 312% year-over-year growth. Now, I think one of the main risk factors that is facing this company is basically management's ability to manage expenses. Now, I've covered this more in detail in this video, which I will link over here, but by and large, the high-level understanding is that, their marketing spend as a percentage of overall revenue has been pretty high. Now, although in the last couple of quarters, they have seen it actually come down, it is still at a high level, and it's important to pay attention to how much they can continue to reduce this percentage, continue to cut their costs in terms of their marketing while still maintaining member growth. Now, as an investor, I think another important aspect of their business to pay attention to is their overall number of subscribers and the percentage of subscribers on personalized solution. Now, I believe in the most recent quarter, that our subscriber count basically came in at around 2 million subscribers with an average revenue per subscriber of around $67. And so this is up 44 and 24% year over year respectively. Now, why is it that the percentage of subscriber counts on personalized solution is actually important to them? Because I think this actually creates the large part of their moat against bigger companies like Amazon that are trying to enter the space. You see, the larger number of subscribers on a personalized solution, the less likely these people are to leave their platform. And so for the first time in history, the number of their overall subscribers that are on a personalized solution has crossed the 50% mark, and we want to see this number continue to rise as the quarters go on. Now, earlier on, I've actually mentioned that this company is very sensitive to the changing narrative around it, because we have seen that, even news about a drug that is not manufactured by the company can also actually affect its stock price. So I actually want to talk about one of the biggest stories surrounding Hims and Hers, which is the GLP-1 shortage. Now, if you want to hear me talk in a little bit more detail about this, I will link another video over here which I go into a little bit more detail, but I just want to give you a high level understanding over here. Now, basically, if you want to think about how GLP-1 actually affects their overall business, in the last quarter, we actually found that GLP-1 only made up around 10% of their growth in the last quarter and around 13% of their net income growth. And so the narrative around this company that they are actually reliant on GLP-1 is actually quite far off the mark. Now, currently what Hims and Hers are doing is that they're actually offering a compounded version of semaglutide, which is on the FDA drug shortage list. And so the concern here is that once this component is actually removed from the shortage list, they will not be able to continue selling their product. But Hims and Hers are not just playing on the defensive. You see, when it comes to this whole GLP-1 shortage issue, they actually have taken a more front foot approach. They have actually written a white paper on this issue, and at the same time, they have also released a GLP-1 shortage tracker where they actually document down the experiences of some of their customers that have interactions with their platform and their experiences with not being able to access GLP-1s, and they actually release this data openly for the FDA to use. And so because of that, I think this company will either do well and the stock price will skyrocket, or the narrative around this company will change, and I won't be surprised to see it falling back to $12 per share. Now, going into 2025, I think it's important to continue to pay attention to how much protection Hims get from the 503A exemption. Now, this wasn't something I was actually particularly paying too much attention to initially, but as I started to dig a little bit deeper, as more people started to talk about it online, I realized that there's a clause here that actually allows Hims to produce a compounded version of drug as long as it is done to an identified individual patient based on a personalized subscription, which is basically their whole business, providing personalized care for their customers. So this is something that is actually working for them. And so I think, because they are potentially market leaders in this very niche but ever-growing total addressable market, and they're also a company that has taken on a very front-foot approach, I'm actually putting them above AMD in this list. But at the same time, with how sensitive they are to the changing narrative in this company, although in some metrics they actually look cheaper than AMD, I'll still consider them to be slightly more on the rich side in terms of their valuation. But as an investor, I guess you have to decide for yourself whether or not this volatility is something you can live with, because it is part and parcel of investing in smaller businesses. And so, of course, the assumption here is that we do not go into a severe recession in 2025, but this next company has much lesser concerns when it comes to valuation as well as regulations, and I talk more about it in this video over here, and I'll see you in the next one.